Hello, we're gonna chat a bit about Ternium. This is a steel company that seems to be a big thing right now amongst investors. It's been mentioned a lot. It seems to be enjoying some hype. Yet it did go down 6% last Friday. That's fine, doesn't really matter. What we want to examine is how the company is doing financially and whether it's a potential good addition for a portfolio. Now, for gold, steel, and all these construction materials, markets tend to be very, very cyclical. When things are nice and there is a booming economy, they tend to do great. When the economy goes down, they tend to go down with it. So bear in mind that this can be a little bit cyclical in nature, but value is important, and even if there is a little bit of a downturn at some point, these kinds of companies, as long as they have enough cash flow to meet their needs, will be enjoying some growth eventually in the future. So let's examine Ternium. The shares outstanding of the company, they seem to be steady over here. You will see that they're not getting increased at all or decreased. That's absolutely fine. A hefty dividend yield with this one, so you will be enjoying almost 4% dividend yield over here if you buy this company right now, which is nice. So bear in mind that when this happens, quite a lot of cash tends to be removed from the company's cash flow reserves, and so they may not be growing as much. And also the company stock price may not be growing as much because removing cash flow does affect the stock price, of course. It affects the reserves of the company. That said, it does make you some money. So it's good to have some nice dividend yield if you are looking for these kinds of stocks. Also, you need to remember that money from dividends is taxed differently. So make sure that you consult your tax consultant to see whether it's worthwhile for you, because it really depends in countries. Some countries actually do tax dividends, others don't. So there's a lot of discrepancy over there, and it's good to know about it. Let's examine the dividend a little bit, and you will see that the payout ratio over here is 11%, which is very, very low. So the company does have a lot of money to pay dividends back. But the interesting thing here is that there has been a little bit of a drop in the amount of dividends here. So it used to be $2.10 actually, and now it's down to 0.8. So, and this must have contributed to to some of the fall that the stock had in these years, although it has been actually going up since 2020 or so. So yeah, maybe investors took this nicely. Generally speaking, when a dividend is slashed, investors don't really like that. So let's take a look at the financials of the company, which is obviously the most important thing. The income statement, a company that's a little bit all over the place with year-over-year growth, and you would kind of expect that again because this kind of industry can be very, very cyclical, and it is very cyclical. But right now, in the current market, they're enjoying massive year-over-year growth and massive gross profit growth over here. And you will notice that their net income is also increasing massively over here. So there seems to be a lot of production and a lot of sales for steel right now, and the total equity of the company increasing as well, and going up to $11 billion. Pretty nice over here. The cash flow of the company, you will see here that the operating cash flow keeps increasing and increasing, approaching almost $2 billion right now. This is nice to see. Cash from investing, the company is investing a little bit in the markets and some capital expenditures, normal stuff. And in terms of financing, the company seems to be paying back some debt, as you can see here, which is nice, and also paying some of the dividends, obviously. So they didn't pay any dividends over here in 2020, it looks like. Interesting, okay. And this can happen again with these kinds of companies. They could be slashing dividends just because there's a downturn and the cyclical nature of the market does not allow them to pay this kind of dividend. So bear that in mind. Free cash flow over here, billion, 500 million, 1.2 billion, 1.3 billion. Typically at around $1 billion. Very, very interesting. And if you picture this company making $1 billion on average a year, let's say, you could give it a multiple of 10, just because it's a cyclical company, may not be enjoying steady growth, and you would still be below its market cap. So multiply this multiple of 10 to $1 billion on average per year, and you will be below this market cap if you're willing to go with $1 billion, because this 5-year average is probably a little bit less than a billion, just because of this year though, which was in the minus. If you just take just these years over here, you're looking at about $1 billion on average. And a forward PE of 3.1 is very, very low, obviously. And again, you would kind of expect that in some situations for these kinds of companies being undervalued just because they have this kind of cyclical nature within them. Solvency, not much debt over here, and actually they are paying back a lot of their debt. Actually, I really like to see that, from 56% going down every year, apart from this one, and reaching 15% over here. So pretty neat. I mean, the company seems to be moving on well, and I like that when the company has controlled debt, because you need debt to grow. But these kinds of companies that are paying investors back and potentially don't have that much growth to enjoy, just again because of the cyclical nature of the industry, it's good to know that they don't have too much debt, because that can cause them lots of issues later. Of course, they would be financing and getting some debt for potentially making new factories and stuff. But if they overdo it, they may build all those factories and then nobody's buying steel, right? So that matters as well. So yeah, the company is looking nice over here. Basically, financials look pretty nice. Again, I'm always a little bit cautious when I'm examining companies that are very, very cyclical in nature. But regardless, I mean, this kind of company to me looks very nice, especially for making some income because of the dividend yield. So you could definitely get this company added in your portfolio, especially if it drops a little bit more, actually, because it seems to be following the market's downturn route right now. Because the more it falls, the better the dividend yield will be. But if you get the 4% of your money and such a low PE and price to cash flow ratio, basically, you'll be doing well. I'm pretty sure over the years, even if there is going to be some sort of of a cyclical nature in the markets, which will happen eventually, and a price to book ratio which is less than 1 over here, which is pretty nice. So this points again to an undervalued company. So yeah, what would I do with Ternium? I do have quite a lot of income stocks, like dividend stocks. I didn't want to add more actually, but if I were to add a new stock in terms of my dividend portfolio, I would definitely look into this one. It looks very, very cool, and financials are looking stellar. Again, advising a little bit of caution just because of the nature of the company. But other than that, I see this company as being pretty undervalued actually right now. And I could definitely, and they have some very nice facts around their operations, like they don't increase shares, they don't have debt, they're making good cash flow. So I mean, they're giving out some nice dividends and a low dividend payout ratio. I mean, why not just add it to a portfolio? So yeah, I would definitely buy this stock. Thank you for watching the video. If you did enjoy this one, you may want to take a look at the other video that I have made a little bit earlier, in which I'm talking about a favorite stock of mine, Intel. And if you haven't watched that, you may want to take a look after you're done with this one, which is right about now, I suppose. So thank you for watching again, and I'll see you soon. Bye bye.